"2022 has been a challenging year for muni investors. Supply-side disruptions and surging commodity prices have caused inflation to remain stubbornly high. The Federal Reserve is raising rates faster than initially expected, and the U.S. muni market is in the midst of one of the largest outflow cycles ever. Sharp outflow cycles have historically signaled buying opportunities as valuations need to cheapen enough to draw in new buyers. We see an opportunity in munis today for U.S. taxpayers for a number of reasons. First, valuations are historically attractive versus taxable fixed income. 10-year munis have cheapened from trading at about 65% of U.S. Treasuries at the beginning of the year to as much as 100% before settling in recently at about 85%. Tax-exempt munis have also cheapened relative to taxable corporate bonds, and absolute yields have risen significantly as well. 5-year munis at 2.25% to 2.5% tax-free are near the highs of the last decade. Secondly, credit fundamentals are largely improving across state and local governments, as we discussed in our most recent Munis in Focus Outlook. For example, the state of California has a record budget surplus of $98 billion, and the state of Illinois was recently upgraded for the first time in 25 years. At the local level, property taxes make up a large percentage of revenues collected by local governments. Home prices have appreciated by 10 to 15% in many areas over the last year, and this will be a tailwind for local government credit in the years ahead. Lastly, as the pace of monetary policy tightening has increased, recession probabilities are rising. We're looking at our portfolios increasingly through a late cycle lens, and we tend to favor tax-exempt munis late cycle. For a few different reasons. Number one, they have lower default rates than investment grade or high yield corporate bonds, lower correlations to equities, and tax-exempt munis have historically outperformed taxable fixed income during Fed hiking cycles. As an active manager here at PIMCO, we're seeing a wide variety of attractive opportunities in the muni market lately. We've seen opportunities in the utility sector to purchase investment-grade tax-exempt bonds that are trading at higher yields than where taxable debt backed by the same issuer is trading. Prepaid gas bonds backed by U.S. financial institutions are trading at tax-free yields of 3.5% to 4% in 5 to 10 years. That's a taxable equivalent yield of about 6%, which is higher than where parity taxable risk trades. We're focused on smaller local government issuers with improving credit fundamentals that offer a yield pickup versus larger, more well-known issues. And then lastly, we're finding opportunities in single name credits that actually benefit from inflation, such as multifamily housing projects that tap the U.S. muni market to finance affordable or workforce housing. In short, with higher yields, cheaper valuations, and wider credit spreads compared to the start of the year, muni bonds offer a particularly attractive opportunity today for those seeking a tax-efficient way to invest late cycle without sacrificing on credit quality.